Hello friends, I'm C. Sanchit Jain and back with Season 3 of Financekefunde. Season 1, we discussed basics of financial planning. In Season 2, we talked about basics of fixed income investing. In Season 3, we'll talk about equity investing. Let's begin today's session with the case study of Shikha, who is an entrepreneur based out of Pune. Shikha realized there is a huge demand for toys in Pune which is not being met. She decides to use her savings of 20 lakh rupees to set up a small factory to cater to this demand. This form of business is known as sole proprietorship, where a single person is responsible for the entire business. Her hard work and focus on quality ensures that her toys are very popular, and soon she starts getting orders from Mumbai as well. She approaches her friend Rajiv to also come in and join the business. Rajiv comes in with the additional capital of 20 lakh rupees, which is again invested into business to hire some new employees, and the production starts again. Rajiv is also responsible for taking care of marketing activities while Shikha looks at operations. A form of business where more than one people are involved in day-to-day activities and businesses would be classified as a partnership. To double the efforts, the popularity of the company toys is increasing day by day, and soon they start getting orders from other cities as well. They decide to expand the business to Maharashtra and nearby states. In order to do that, they want to install some machineries in the factory to make some of the processes automated. They require a larger surplus for this, and they decide to reach out to their friends and family. As more money pours in, the business will become bigger. Hence, they decide to opt for the company structure of business. In a company structure, people who are running the company are separate from the company as a whole. That is to say, the company enjoys a separate legal structure. In this case, the liability of the company is also limited. The current form of company with which Shikha and Rajiv are operating is known as a private limited company because it is for a closed group only. With both popularity and orders increasing day by day and support from the Manufacture in India initiative of the Honorable Prime Minister, they decide to expand their production to other parts of India as well and set up local plants in other states as well. For this, they need further capital. They decide to borrow this capital from public at large, hence making their private limited company a public listed company. They issue an IPO, which is also an initial public offering, inviting people to buy into shares of their company. This way, they are distributing the ownership of the entire company with a lot more people who will share the profits and losses of the company. However, these people will not form a part of the day-to-day operations of the company. But since they are also part owners of the company, they would be consulted for any major decision in the company, and a proper meeting would be called in for this. We see annual general meetings or AGMs being held by the company to discuss such important matters. At times, where these matters are being dealt on an emergency basis, we also have EGMs or emergency general meeting. Next, we'll discuss equity market segments. Equity market has two major segments. First, an interaction between the company and the initial investor. This is called the primary market. Raghav was the person who had invested at the time of IPO. The deal between Raghav and the company is a part of the primary market. This market typically deals with new issues of the companies. Suppose another investor comes in and wants to buy Raghav's share of the company or some portion of it, then that deal which happens would be a deal of secondary market. So this is the market where prices fluctuate day-to-day basis. Let's move on to why we invest in equity. What are the income factors we derive from equity? So first income factor is through an interaction between the company and the investor. This is in form of dividend income. Whenever the company makes profits, they may distribute some of this portion back to the investors in form of dividends. This is an optional activity and there is no mandate to distribute such dividends. The second major earning source is through capital gains, which is an interaction between two investors whereby one investor is buying the other investor's shares. That's it for this episode. Thank you for watching. Please share your feedback in form of likes and comments, and if you haven't subscribed the channel yet, please subscribe it right away. Thank you.